Hi, my name is Sujoy Burden, and I am the founder of this company called World Group Solutions. Uh, this presentation is mainly targeted for advisory firms and wealth management firms, where I would highlight using artificial intelligence and machine learning capabilities how farms can save cost and at the same time scale with AUM exponentially and at the same time get pretty decent returns from investments. Uh, we also have strategized our research to a point where we could secure the investor's return. So I will cover all of that, but advise, of course, I will not be able to cover all the components of this particular uh, presentation because it's very detailed, but feel free to get in touch with me if you have any questions, and I will demonstrate those particular questions if you might have any at a very detailed level with you on a one-to-one conversation. But I will try to keep this conversation and presentation at a very high level. Of course, I will try to give you some details of the strategy and how artificial intelligence can help you to scale and save cost. So the very first component of there are two major components. One is the predictive model, which identifies the breakouts from the market. It looks into fundamentals, it looks into technicals, it looks into patterns, it looks into the last minute news and all sorts of stuff before it makes a decision for investment. Of course, there are no human emotions, so performance and efficiency is cannot be even compared when it comes to any humans or any traditional techniques. So this mindset required for artificial intelligence is slightly different, and I will try and brief you in terms of what are the differences between traditional and artificial intelligent techniques with strategies. So we focus only on US equity market. Of course, our algorithm and predictive model works in 43 exchanges around the world. We are also a vendor of Interactive Broker. So wherever they are, we can just plug it, we can do a plug and play with their exchange, with that particular exchange, using our predictive models and uh, order engines. So we have basically, as I said, we have two main products, and I will try and demonstrate how these products are deployed into our clients' services when we do through SaaS model. So every client, if you happen to become our client, you would be assigned with a virtual machine in Amazon, and these virtual machines would depend on how many accounts you have. So here, if you notice, the instance size is R4X large. So you can keep going, scaling it up more and more, depending on the processing speed and all those type of things which you need. So I will talk to you about it. In this particular machine, we have got two accounts which I will be displaying. So let me log in first. So people who are familiar with Interactive Broker would find it very easy to understand. But advisors or wealth management firms who have not used Interactive Broker, just to let you know, to my knowledge, as on today's date, uh, there are not too many brokers in America who can support third-party artificial intelligence. They are the only ones who are in the market today supporting third-party artificial intelligence. And that's why we chose Interactive Broker as our uh, brokerage, I mean, as our custodian for our clients. The second reason is, of course, they are a lot cheaper as compared to other brokers in America. So, having said that, that was the key reason for why we chose Interactive Broker for plugging in artificial intelligence. So this is mainly this server which you are seeing here as a virtual machine is dedicated to a client, of course, say for example, you are become our client, you would be dedicated with this particular virtual machine. You'll be given a new virtual machine depending on the size and size of your account and all those stuff. Those are all configuration based. So if you're familiar with Interactive Broker, basically our support team, this is through auto login, but I will just try and demonstrate uh, how this is happening. So it is going to log in automatically into both these Interactive Broker accounts into their TWS. Once it logs in, you will notice that we are also going to connect our order engine here, which going through an API directly to uh, TWS of Interactive Broker. So again, people who are not using Interactive Broker will find these terms a little different, but what we are doing essentially here is connecting the the brokerage platform with their API and our intelligence, which is the machine learning intelligence, which you have just seen. So I will connect it here just to demonstrate. So see, it's done the connection right now, and I will start the order engine. So as we start the order engine, every client, every account has its own configurations. So what I'm trying to point out here is this is where the cost saving and expansion comes into place. Say, for example, you have uh, individuals, say 200 high net worth individuals of 200 million. Now, every individuals have different appetite of risk versus tolerance. So you might have 3 or 4 classifications, maybe 2 or 3 classifications of configurations. One who could be a moderate risk taker, who could be another one could be a very conservative, another group of people or group of accounts could be very aggressive. So depending on that, you can group them up into each of these pipelines which you are seeing here. These are nothing but pipelines with different configuration. So you can have 5 or 6 pipelines running for you at different configuration level. You can expand businesses with pull vehicle if you're not doing that. You can support advisors who are not with Interactive Broker. You can support institutions. You can support hedge funds. You can expand your AUM as much as you want with different configuration level. So that's the key point which I'm trying to emphasize and highlight, that you can scale your business without the need for a resource. So because the artificial intelligence and our order engines will take care of it. The second important thing is you might be having, say, 2000 accounts where there are dedicated 20 people into those 2000 accounts. You can cut them out. You can cut short your resources to probably 2 or 3 and still manage the 2000 accounts which you have. So the point here is you can expand your AUM or you can cut down on your existing costs. So our goal here with artificial intelligence is to see if we can help your farm's bottom line profitability. So having said that, of course, your scenarios could be different. So please schedule a meeting with me, which you would see on the link, uh, and ask me your specific question so that I can answer it very specifically to your needs. But I'm trying to see if I can give you a proposal based on the data which we have and come up with a value propositions in areas where you could save cost or scale, and at the same time, of course, get decent returns for your investors. So having said that, I feel personally that using artificial intelligence would not only help your farm to save cost, it'll scale, but also at the same time you maintain a consistency of performance. No matter whatever is your configuration level, you can do all of that. I will not get into all the details of all this because there are so many small components to discuss. But of course, feel free to get in touch with me, schedule a meeting, and if you have any specific questions as to what I'm trying to show here, but I haven't spoken about because of my limited time in recording, we can discuss that further. So every client would have a dedicated virtual machine on Amazon, and you can have two, three, four, or five accounts. As you scale your accounts, as you scale, you'll probably need a lot more processing speed and memories and all those type of stuff. So having said that, I'm going to close this virtual machine and cover the other components of what I wanted to discuss. But this is something which we do as a support from our engineering team on a daily basis for our clients. So every client would have a dedicated machine, and you might have one, two, three, four, five, six accounts. It doesn't matter. Whether it is a $20 million or $100 million, it's all based on configurations which we will be talking about. But when it comes to the memory, whether it is 100,000 or 100 million, the memory utilization will still be the same. So in this particular context, what I'm trying to highlight is even if you have a smaller amount to handle or a bigger amount, your memory utilization will be uh, exponentially growing depending on the number of accounts you have, not the AUM when it comes to virtual machine. So let me stop this first, and then we will talk the other components of what we need to discuss. So I have just stopped the virtual machine, but I have demonstrated that how these virtual machines are dedicated to each of our clients depending on the number of accounts they run. So the second point which I wanted to highlight is we have, as I just mentioned, that we have a predictive model which basically throws the potentials of the breakouts. It could be on the buy side or it could be on the short side, doesn't matter. But the predictive model is something which we say, for example, today it's August the 6th. It's around 7:22 a.m. when I'm doing this recording. The predictive model already throws certain amount of potential trades uh, to us ahead of time. That's the one of the features which I wanted to highlight. These could be in the form of, I will show it to you in a minute now. If I take this example here, so as I say that investors on for 8/6, if you notice, there were 200 buy potentials and 413 short potentials in total from the market. Of the After scanning the entire market, it finds there are around 623 possible breakouts, but that scenario will change as the market moves on and the order engine which you have just seen in virtual machine takes the final decisions, the last second decisions. It looks into all the looks into all the parameters which it has got, which means it is also looking into scenarios. I'll give you an example here. Like here, you have a lot of what do you call configurations, which is for that particular account. As I said, every account can have a different configuration. Here, I'm trying to highlight, and these things would drive the the what do you call the objective of investments. So these configurations are objective driven, and I will explain to you as to how precision based techniques would lead us to those objectives. So in this particular case, this particular account, I will open up that account for you so that you can understand it a little bit more better. Okay, so this is the account which I'm talking about, which you are seeing here. Now, this investment was of $1 million. It started around February 28th, say March 1st. I'm running the report till the end of July, which means it's 108 trading days. The initial investment is of $1 million roughly. It has realized a profit of 214, and I will go into that detail a little later. You will see that. Uh, realized profit has been secured. So what we do with our strategy, due to the velocity, which I will explain in a minute, we are able to whatever profits we realize, and we realize profits every day. Big or small is a question mark depending on the market conditions, but these realized profits are not compounded. So time weighted average and all those type of things does not play a very important role here because the realized profits are withdrawn. So I will give you an example of what is happening with this particular account. So if you take a look at that, so in other words, in 108 days, if you have made 214,000, you're averaging to around $1,900 a day. So your realized profit till date in 108 days, you have made around 21%, which is equivalent to 0.19% per day. That's a very important calculation for our precision based techniques. Now, unrealized profit for that particular day, which was July the 31st, was 195,000, which is the negative side. So the unrealized profit is minus 19.57%. So having said that, in order to cover up 19.57% at this rate, which you're talking about 0.19%, you're looking at 99 days of trading. So right now, if we have traded for 108 days, we have already did a break even on this particular portfolio. Now, again, as I said, that technique, the different strategies would lead to different investments, would lead to different targets, and different targets would cater to different strategies in artificial intelligence. So, having said that, this particular person has a goal to cover up to make a profit of 800,000 because he needs it for two kids' education. So I'm assuming this that there is also a fees of 26% or so. So effectively, you are looking at around 1 million plus in terms of return. Now, if you take that and project it into how many days he would be looking for that return, is nothing but the amount which is the return in absolute term divided by the number of realized profit per day is the number of days which he is looking at, which takes you to around February 2021. So here, of course, the markets will drive that date, but the point here I'm trying to make is he is able to make $1 million as return, which points back to roughly around 39.49% if I'm not wrong. No, this is the number of folds. So, which is roughly around 49.97% in 252 days. So, and these are the numbers which I will also show it to you is from the statement run between these two dates in Interactive Broker. But I'm trying to explain the strategy and the philosophy behind the artificial intelligence which is working behind it. So here the goal, as I said, was for two kids' education. But here again, you could have another different type of configuration that, okay, you know what, I'm thinking in terms of the difference here is is on the returns on the percentages which you're looking at around 734 days. So by explanation here for this particular thing is that if I'm going for 734 trading days, which will be basically 2000 and January 31st, 22, which is equal to 734 trading days. That means here in this case, with this configuration, if you're looking for a target date that okay in 3 years time or 5 years time what type of return I can expect is what you are getting here based on the daily average. Now think it on those lines that you have made an investment, you had a go, you have in this rate, at this rate, you are basically looking at 98 days to break even. You're taking a journey for 734 days. You're making an average of 50%, 50.30. This is also based on an account which I will demonstrate to you. So if you are looking at this, think it this way, that you have made 1.2 million in 734 days and you are maintaining a float tolerance. This is again the configuration factor which goes into the algorithm that it will not invest anything new below this tolerance percentage. So for example, if you're looking into the tolerance percentage here is say 19.5. So effectively what you're looking at is you're setting up your tolerance below this percentage. So now after 4 years or 3 years, whenever this period ends, 2019, say 3 years, you have already made 1.5 million after the fees or considering the fees. So at that point, you can wipe out the unrealized profits of 195,000. So that's one way to look into it. So if you're looking into long-term investments of say 3 to 5 years, setting up your tolerance level or unrealized profit to a certain threshold and continue growing your wealth every day at 0.19%, you are going to reach at 1.5 million in 734 trading days. That's one way to look at it. The other way to look at it could be that, okay, I want to keep my funds liquidated. There are advisors with whom I spoke to, and they want to keep they're interested more on hedge funds and they want to give them a product which could be liquidated. So if that has to be the case, then the configuration changes a little bit. So here you will, in that case, you will be able to give a high risk tolerance. Of course, higher risk tolerance will get you higher returns, as you can see. In that case, you're giving a lower risk tolerance, which is around, say, around 4%, and you're getting around 35.99%. Of course, what is happening here is as you lower the tolerance, your lower would be the unrealized profit. So as time goes, you are basically knocking off that percentage, that realized unrealized profit, even from the portfolio at the time when you're closing the account. So if you really look into in this terms, basically, of course, your returns will be a lot lesser because you're taking a lesser risk. But as the if you want to keep your the offering liquidated, yes, the hedge fund company or whoever you are targeting would be able to uh, close the account after 42 days with a mark to market with a positive number. So as I said, it's all configuration driven. So having said this, I will try and plot, demonstrate these numbers with, and these drives the configurations. If you notice, the configurations are driven accordingly. So if you see here as an example, This particular account, the tolerance was set at 19%. So when the markets gets bear, it does not trade. So there are times when the market gets bear and bull all the time, and the trading gets stopped. So basically, as it exceeds the tolerance level, we call it as a float. There are no new investments. But as and when the tolerance level is below that threshold, and you have available cash with you, which is this one, because as I said, in artificial intelligence, the order engine is scanning for opportunities every 120 seconds, which is not possible through um, human beings. In traditional technique, this is practically not possible. So as a result, we are able to generate pretty decent profit. But I'll come to that in a minute, uh, which is, let me show it to you here. Uh, the point here I'm trying to make is that we had a $1 million with us for 108 days we have traded, but I will show it to you on statement. The total purchase was 39 million. And as I just displayed, the threshold per investment was 6,000. We take the lowest threshold. The reason being is the mindset in the artificial intelligence is the amount you're willing to lose. So we do not have a specific control or emotion in terms of setting stop losses for every different stocks, which is done traditionally in traditional technique. Say for example, you are putting in on Facebook 200,000, maybe your stop loss would be at 2% or 3%. But if you are investing on Bank of America, say 50,000, maybe you will put your stop loss at 5% or 6% because your emotions are playing on it. Here we take a different approach. We take the amount we are willing to lose and then plot it with the money, as I just explained, that how much is the threshold. Say for example, here in this case, my leverage is 1.8. That means Interactive Broker, those who are familiar with Interactive Broker, up to 1 is your own money. Beyond that is the margin loan. So in this particular account, the tolerance is given to a point that, okay, you can use 1/4 of the margin loan. But if you look into this particular account, which is a simulation based on a different configuration, here we are not letting any leverage to be used. So what is happening here is we are using little portion of the cash uh, uh, as a leverage. We are not using all the money. We are using a portion of it. So if you take an average of this, it will be roughly around zero point 0.6 or zero point 0.7. So the point here which I'm trying to make is that if you want to scale it up, if you want to scale it up from the leverage there was 0.65%. Now if you want to scale it up to 1, that means you want to increase your leverage to your most to the available cash and utilize all your available cash, then in that case you're moving from 35% to 55%, keeping all the other factors constant. So in based trading, everything is based on numbers. So if I have to increase from 0.65 to 100%, I mean to point, I mean to point, I mean 1 point something, which is 100% of my leverage, then maybe I have to increase my investment threshold from 15,000 to 23,000. So this is exactly what I'm trying to explain here, is that if I have to increase it from zero point 0.6 to zero point 0.9, in that case, I'll have to increase that leverage from 15,000 to the investment per stock from 15,000 to 23,000. So the the most important point is you are getting a better return from 35 to 55 without involvement of any human beings. So that's exactly the benefit of artificial intelligence and precision based trading, that you can scale. You can perform better, you can do all sorts of stuff. Of course, when you're increasing your leverage, your tolerance or unrealized profit percentage also will probably go up to maybe -5 or -6. But having said that, if you are doing a long-term trading, coming back to this, where you have already made 1.5 million, assuming you are doing it here, you are doing going long term, you have made 1.5 million. What is the big deal to the day when you are closing the account to write off your 195k? So having said that, because there will be some sedimentations, as you'll notice that which I was trying to show here. If you take a look at this particular account, it has traded almost 6,500 stocks so far from in that date range, and out of which only uh, 13 and 5, say basically around 17 or 18 stocks are floating. So this float, which is in the risky zone, so which means it will, as the market gets bear, this will increase a little bit. So that's why it is called sedimentation. So at the end of 5 years or 4 years, there will be some stocks which will be on float as realized profit, which has to be wiped out. So this is exactly what I am trying to refer to here, that when you're closing your account, those are some of the stocks which will be in unrealized profit, which needs to be cleared out. But the client or the investor is walking away with a profit which is secured, and I will come to this little later. Every week the money which has been made is taken out. So now I'll try and show you the account which I'm talking about is this particular account with which has the $1 million investment going on. Or the second important thing was our predictive model throws a lot of breakouts, but those breakouts depends again whether it will be used or not used, depending on the buying power, the leverages and all those type of things, the market conditions and so on and so forth. So if you take a look at this particular on August 5th, if you look at the breakout information on August 5th, there were 742 breakouts given by the predictive model. But the order engine restricted everybody. They did not invest on any because the market was very bare. So every decisions made by the order engine is a last minute decision. So when the market gets bull and you have buying power available with you, you'll notice that it's buying a lot of stocks. Here on this particular day, the market was 0.42 in the positive direction. So it has invested on 116 stocks from those breakouts. Again, it uses its own intelligence to milk out the profits, but the purchasing part of it is also controlled by the leverage which it has been assigned with. But all the investments are of $6,000, which you will get to see. So having said that, these are the pluses of artificial intelligence where humans are not involved, decisions are made instantly, and your funds are constantly rotating. This never happens in traditional technique. So having said this, it leads to performance, right? So now I'll throw up something on performance on this particular account for last few months, which you will get to see. Let me copy this here and paste it here. So now this is the performance which we are talking about. But and this is exactly what I just mentioned for this particular account. For this particular account, live, which we are showing about is in terms of the performance. As I say that we are projecting into 50% return, and in 108 days, we have made around 214,000 from $1 million, which is heading towards 50%. And we have rotated funds around 39 times, which brings the velocity. So the key point here is because of our velocity, we don't need to compound it. We don't need to compound this return. It can be taken out and secured in a bank. So this is one of the key factors of our research, that we generate enough velocity. We have traded 39 folds. 39 million times means 39 folds in 108 days. It's a huge velocity. And all the trades leads to if all the trades leads to a profit, which you will get to see, there's no reason why you will not make money. And secondly, you don't need to circulate this money. You can take it out and keep it in a bank secured, because you are rotating your funds anyway. So having said that, that's the strategy we use, and that's how we can secure it. So I will explain to you here that how this particular investor is securing the money every week. So, but before that, I will jump into the performance. So as I said, from February onwards, we had been tracking it till July, where we had some very nasty months, but I will try and show you in terms of our performance. For the month of for the month of March, we were at 4.74, where the S&P was 1.29. So we did beat S&P by almost like two folds or three folds. Here in the month of April, S&P was 3.49%, but we were at around 9%. So again, three to four folds here. In the month of May, which was a very nasty month, 6.78, we were at 1.64, and this is the money which has been realized, and I'll come to that a little bit in terms of the money being withdrawn. So we were at 1.64 in the month of, so here I'm talking about almost like 5-6 folds. In the month of July, S&P was 6.91, we were at 3.03, means we were recovering at this stage. So if you take a notice, our float went up to minus 26%. So at minus 19%, all investment was stopping. The algorithm will not invest if it goes beyond that tolerance. So the following month, it came down to minus 19%. So which means that this month it has invested. So there was a makeup here. Although the S&P was 6.9, but the previous month was very bad. So in this case, the algorithm did make up for previous month's float losses, which we had here. Then again in the month of July, S&P was 0.3, we were at 3.39, here almost like 7-8 folds. So if you notice, I don't think our performance when it comes with a comparison of S&P is at all bad. I'm not sure about how every wealth management firms or advisory firms are doing, but you can make a comparison of this particular scenario of these months, especially in the month of May, what happened. Because in traditional technique, you compound your returns. So how much your net worth shrinked is a very important question. In our case, with our strategy, the net worth, the money which has been realized, is taken out. So I will now take you to the statement of this particular account. You will see, let me first log in here. It needs a phone authentication. Just a second. I'm having a hard time getting a phone authentication here. Just a minute. There I get it on my phone. So I'm running this. I'm going to run this. I've already run the report because it takes a long time, but I will get into the statement right now for that date which I was talking about from February end to the end of July. So I'll look into that statement and I will run that statement from February 28th to 31st of July, and that's exactly what I'm trying to show you here from 28th to 31st of July. The key point which I'm trying to talk about is the realized profit which has been taken out. So that's the first thing I would like to show it to you, that this is the money which you have made. And if you notice, I'm going to open it up here. Of course, here time weighted return does not make sense for us, but I'll try and demonstrate that 214,000 was withdrawn. Every week, this profit which has happened is withdrawn, and this is exactly what is demonstrated here. So the point which I'm trying to make is the money which this person is targeting for to make 800,000 is secured. This is the key of our research. At the end of 2021, he will have something to look at which he can use for his kids' education. But in traditional technique, I don't think anybody can tell that, okay, you know what, in 2021, I will get you 800,000. But in our case, with this strategy, as I'm demonstrating here, this money is withdrawn. Every week, this money gets withdrawn and gets into a bank account. So this is the key difference of our research. The second point which I wanted to mention is the rotation which you are looking at. Oh, this is the realized profit as you have seen. If I scroll down all the way down, that's the 200. If you notice, there are not too many trades which are negative. Sometimes out of $6,000 investment, you're making $1,400. And I'll get into the trade log also in a minute, but just to give you an idea. So this is the 215,000 which we are talking about in those 4 months time. This was the float which I was referring to, minus 195 here. So this is the money you have made. This is the float you are doing. So effectively you did a break even and all those stuff which I just explained, and you have traded for 39 million dollars. So let's take a look at that also. So now let me go back to cash report if I can show you. I think it should be down here. There are a lot of trades, but let me see if I can bring it down. I think it should be somewhere here. There you go. So you look at the cash report, you had a total purchase in last 5 months of 39 million. From $1 million investment, you have circulated your money at such a high velocity that you have generated profit. And as I just mentioned, that as you are going through the settlements here in realized profit, you are looking into this column, you will hardly see anything negative, hardly, maybe one or two, but you will not see anything negative. So this adds up to 215,000. So this is the money which has been withdrawn. So now you come back to this question and think about it that way, that yes, the physical money is withdrawn. So it is in a bank account, not in the trading. So if you look at this every week, this person is withdrawing the money into the bank. So all these things totaling up from here to here is that 213 $10,000 which I am referring to. And when it comes to performance, I have already shown you how we are performing. So the key selling feature of this particular strategy is that we are able to secure the money by withdrawing it, and reuse the velocity which I've just explained here, that in 108 days we have rotated the funds 39 times, is the key of our research as a recipe, if you may ask. How do we generate returns and how do we secure it? So I think investors like it. Uh, I think you, as a potential advisor or wealth management firm, would be very interested in what we do, because this is not done in traditional technique. And this is happening because of the fact, which I will show it to you in a second, if I can go there in a minute. If you look at the trade logs and now you think whether an individual can do it or not, I'll just give you an example. I'll pick up any trade just to give you an idea. Maybe I see this one on March 18th, it went in at 10:48. On March 19th, it came out at 10:45. Then again, it did not trade for a few days. Then again, it went in. So now you start thinking in terms of every time a settlement is happening, it's around $6,000, as I just mentioned. So you here, if you're looking from March 18th to April 5, means roughly 20 days, roughly, right? So uh, I'll just pick up the calculator just to show it to you. So roughly you're looking at any given point of time, you can say that you have made $142 from $6,000, right? So that's exactly what I'm trying to reflect here, show here, that you are making 142 divided by, say, 6 times 100. You have made 2.36% from one stock in a span of, say, 20 days. So now replicate this. So I will give you another example where you see this. This will be a very interesting thing here to notice. On April 1st, ADSK, hold on. Yeah, I think this is what I was trying to show. See, it bought 72 stocks at 346, at 348, it sold it. It sold those stocks. So it is pooling. What I'm trying to say is that 120 seconds, which I'm talking about, human beings cannot do that. If you take a look at here on 21st, no, this is not a good example. I wanted to show you that it's reinvesting within the next 22 minutes as an example, if there is cash available and tolerance levels are all okay. But I'm not able to find that example. Uh, mm, at 9:32 it came out, at 10:02 it went in, 10:13 it came out with a profit, and you'll notice these are all plus. Okay, there is no chance of having a negative. And then again at 10:20 on the same day it went in. So this is a very classic example. It came out, it bought the stocks. At 10:13 it sold. It had available cash and tolerance level. So at 10:20 it again reinvested, and then on the same day at 11 o'clock it came out with a profit. So now imagine if I am looking at this particular stock from 3.5 to 3 sorry, in 2 months time, on this particular stock at any given time I have $6,000 invested. I've already made 650. So now this is what brings the replicating effect of such high returns, as I have demonstrated here, that why are we performing at that high, with that high return as compared to S&P, is one of the components which I just mentioned, that money is constantly circulating, and it's circulating at such a high speed that we in 105 days or 108 days we have circulated 39 times. That's the key component of our research. So I think I have given a very good explanation about few things: how you can scale, how you can uh, save cost, how the different returns, as I say, that I don't think I cannot compare with anybody, but you guys can look for yourself as to how you have done during these months as a comparison. Uh, where is that? Just a second. So you can compare each of these months, which I'm showing here all the way from February to July, and take a look at our performance as to how this algorithm is doing for and percentage wise. And now let me tell you, in precision based trading, it doesn't matter whether it is 10 million or 50 million or 1 million, the percentage will always be the same depending on the configuration. As an example, if Google is priced at say $103.81 at this minute, it's for all the pipelines, right? Every account would get the same price. So if the configuration is the same, then it will react exactly the same with all the accounts. Again, humans cannot do that. So there are lots and lots of pluses which I can talk about, never ending, with artificial intelligence. So feel free to get in touch with me. I hope I can explain a lot more specific to your questions and configuration, because the configuration is the only thing which will basically drive your returns. And I can walk terms of different product offerings you might have. You might have a hedge fund which you want to keep it at a liquidate state. So anything over 42 days, that person can go and liquidate it. Or you can have certain investments for kids education like the way I have presented. Or you may have RIA accounts where people are not even touching it till the age of 64 or 65, uh, which could be operated through a pooled investment vehicle. So scalability is endless depending on the scenario. And I have explained, I have tried to get some data from the ADV forms in terms of where I feel looking at those data, we could bring in a value proposition for your farm. So please hear this video, go through this video very carefully, and then go through the proposal which is attached with this presentation. So if you have any further questions, of course, I would expect you to schedule a meeting. There's a link for that. Make a note of those questions, and I will try and address it, because there's so many different areas to talk about. But again, your farm's conditions could be different than other the farm. So if you have potentials to expand your business with institutions or hedge funds or other advisory firm, talk to me. We can think about a strategy which would work out. We could think about a configuration which would work out based on the prospects you are talking to, and come up with an AI driven architecture. Uh, as said, consistency is a key here. So if we are able to do this and demonstrate with 1 million, assuming you have another 1 million exactly with the same configuration, you'll get the same type of return. The difference is when you have two different humans, two different emotions, and nobody is working for you every 120 seconds. So you cannot compare traditional techniques with this. And that's one of the reason why we beat S&P with such high folds. We have There are many occasions where our Sharpe ratios are even over 3 and 3.5. On bear market, it is not good. It drops significantly, but on bull markets, our Sharpe ratios are usually over 3, and this explains how many folds we are doing and the type of risk we are maintaining. Having said that, I mean, I will welcome every advisory firms or wealth management firms to talk to me after going through this video and the proposal which would be attached with it. And maybe there could be some very good value propositions which could be cost effective, or you could expand your AUM, and not to mention you are securing your returns for an investor. That's the key value proposition for an investor, which brings a lot of AUM opportunities for you. So feel free to get in touch with me. My number is there on my email, on my website, and I'll be more than happy to address your specific questions. So I appreciate your time once again, and thank you.